Welcome to Talk Tickers.
Glad to be here.
We're your guides for diving deep into the critical conversations shaping the market.
Yep.
Today, we're ripping open the latest earnings call from Shoe Carnival. This covers their first quarter of fiscal 2025.
Right.
Our mission, as always, is to cut through the noise, pull out the really important insights, understand their strategy, and see what management is signaling about the road ahead.
Yeah, both for them and the wider footwear market.
Absolutely.
And it's a fascinating call because, on the surface, some numbers look a bit tough, reflects a challenging retail environment, no doubt. But underneath that, there's this really aggressive strategic shift happening. Management's putting serious capital behind it.
Okay.
So yeah, definitely a lot to unpack beyond just the headline figures.
All right, let's jump right into those headlines then.
Yeah.
First quarter, net sales hit $277.7 million.
Okay.
Now, comparing that to last year, same quarter, was $300.4 million. So that's a drop, 7.5%.
Yeah, noticeable drop.
And comparable store sales, always a key metric, they were also down, 8.1% decline there.
Right. Those sales figures are certainly, soft. Management didn't really sugarcoat the challenging backdrop.
But I sense a but coming.
Yeah, there's a but. Here's where it gets really interesting, maybe a bit surprising. Despite that top-line pressure, net income came in at $9.3 million.
Okay.
That's 34 cents per diluted share. Now, yes, that is lower than the $17.3 million last year.
Right, significantly lower.
But it actually beat what market analysts were expecting by about 10%.
Okay. So they managed costs or margins well enough to beat profit expectations even with sales falling.
It seems like it. Yeah.
That's pretty notable in this kind of environment. And they did this while sitting on a really strong balance sheet, didn't they?
Oh, yeah. Super strong. They ended the quarter with $93 million in cash equivalents, marketable securities.
Wow.
And that CAC pile is actually up over 30% year over year.
Impressive.
And maybe the most critical part, zero debt.
Zero debt. That's huge.
Yeah.
That gives them so much flexibility, right?
Absolutely key. It underpins this whole strategy we're about to talk about.
Yeah.
And you see that flexibility immediately when you look at their inventory.
Okay, inventory.
Levels were up 4% compared to last year.
Wait, up. Inventory up 4% when sales are down over 7%?
Yeah.
That seems backwards.
It does seem counterintuitive on the surface, yeah.
Yeah.
But management was really clear. This wasn't an accident. It wasn't just stuff piling up. It was a deliberate strategic decision.
Okay, deliberate. Why? Why intentionally hold more inventory now?
Good question. So management basically explained it as leveraging that financial strength we just mentioned, the cash, no debt. They're making opportunistic buys now. Securing inventory at what they think are good costs to make sure they're fully stocked for, back to school, holidays, the big season's coming up.
Right.
And it also kind of acts as a hedge, right, against potential supply chain hiccups or, cost increases down the line.
Got it. So using their financial muscle.
Yeah.
Positioning for the future. Smart if you have the cash. And speaking of the future, despite these current sales headwinds and the costs tied to their strategy, which we definitely need to get into management, actually reaffirmed their annual guidance for fiscal 2025.
They did.
That signals some serious confidence, doesn't it, given the numbers we just saw?
It absolutely does. It suggests they really believe the strategic moves they're making now and the results they're starting to see will ultimately get them to their full year targets, even with the near-term impacts.
Okay, so let's dive into that core strategy because like you said, it really dominated the call. The whole theme was the Shoe Station banner and its accelerated expansion.
This is it. This is the heart of the Shoe Carnival story right now.
Yeah.
While the traditional Shoe Carnival stores and kind of the industry they're in saw those high single-digit comp declines.
Right.
Shoe Station, totally different story. It actually saw sales growth of 4.9%. And its comparable store sales were positive in the quarter.
Wow, stark contrast. And this wasn't just a lucky quarter for Shoe Station, was it?
Not at all. No.
Yeah.
Management made a point of saying Shoe Station's been consistently outpacing the industry and the main Shoe Carnival stores for over 2 years now.
2 years, okay.
Its performance is just, remarkably more resilient.
So Shoe Station is clearly the growth engine. What's the plan then? How are they leveraging that?
The main strategy is converting underperforming Shoe Carnival stores into the Shoe Station format.
Okay.
Shoe Station is positioned more as a premium banner. It's got a broader mix of top national brands, especially in athletic and performance shoes.
Right, the higher price stuff.
Exactly. And it aims to attract sort of higher income households compared to the more value-focused traditional Shoe Carnival.
And are these conversions actually working? I mean, do they have proof this isn't just wishful thinking?
Oh, they have proof. Management used the word outstanding to describe the results from the stores they've already flipped.
Outstanding.
These converted locations are generating double-digit sales growth compared to when they were Shoe Carnival stores.
Double digit. Wow.
Yeah. They're getting higher average prices per shoe sold what they call average unit retail. Margins are better, accretive, they said, and they're making significantly more profit at the store level.
Okay, double digit growth, better margins, more profit. That explains why they're not just planning this, they're hitting the accelerator. How fast are we talking now?
The pace is pretty aggressive. Initially, the plan for this fiscal year, FY25, was somewhere between 50 and 75 conversions.
Right.
Based on these strong results, they're now committing to hitting the top end, the full 75 planned rebanners, all within this year.
All 75 this year. And they broke down the timing, didn't they?
They did, yeah. 24 were actually done in Q1.
Right. Okay.
20 more planned for Q2, 25 for Q3, and then the last 6 in Q4.
So bam, bam, bam. It's a rapid rollout.
Very rapid.
That's a huge number of stores changing formats so quickly. What does that actually mean for their store mix by the end of this year?
It's a dramatic shift. They started this fiscal year with just 42 Shoe Station stores. That was like 10% of their total fleet.
Okay, tiny slice.
By the end of this year, they expect to have around 120 Shoe Station stores. That jumps up to about 28% of their total store count.
Wow, nearly tripling the percentage in just 1 year. But their ambition goes even further, right? This isn't the end game.
Oh, much further.
Yeah.
The accelerated long-term goal now, get this, is for Shoe Station to represent over 80% of the total fleet.
80%.
80%. By March 2027, that's a massive leap from their old target, which was just over 50%.
Okay, wait. Over 80% by early 2027. That seems incredibly fast. Where are they seeing this success that gives them the confidence for such a huge, quick rollout? Is it just working in, like, rich suburbs?
Well, that's what's really interesting. Management shared results from different kinds of locations. Yes, okay. A store in affluent coastal Florida saw over 20% sales growth after conversion. Expected, maybe.
Sure.
But rural markets in Tennessee and Alabama, also big sales bumps. And the real kicker was a store in a, quote, lower income, highly diverse market in Georgia, outside a major city. It had been an underperforming Shoe Carnival. After converting to Shoe Station, unexpectedly strong sales growth.
That Georgia example is really fascinating. It suggests the premium format, maybe the better store environment, the different brands. It might actually appeal to a much broader customer base than you'd initially think.
Exactly. Even in areas maybe not traditionally seen as premium.
Right.
If Shoe Station can work in all these different kinds of markets, socioeconomic, geographic, it hugely expands the potential, the white space, as they call it, for this banner.
Suggests the appeal isn't just limited to certain demographics.
Precisely.
But okay, this kind of speed and scale, it can't be cheap. What are the costs involved in accelerating this so much?
You're right. It requires serious upfront investment. Management's budgeting for a P&L hit, meaning it impacts their operating income of $25 million just for FY 2025 related to these conversions.
Okay, P&L hit. What does that cover?
Covers things like the store remodels, the lost sales during the, 4-6 weeks a store is closed for the changeover.
Right. Can't sell shoes when the doors are shut.
Exactly. And the marketing cost to basically reintroduce the store as Shoe Station.
And did that investment show up in the Q1 results already?
Yes. They estimated it had about a 15-cent per share negative impact on earnings in Q1 alone.
Yeah.
And for the full year, they expect this whole strategic investment to lower operating income by roughly 65 cents per share compared to last year.
So near-term profits are definitely taking a hit because they're making these investments. What about actual cash outlay, capital expenditures?
On the CAPEX side, yeah, they plan to spend $40 million this year specifically on the rebanners.
Okay.
That's a big slice of their total planned CAPEX, which is in the $45-60 million range for the year. So yeah, a lot of cash going directly into this transformation.
Given those costs, that near-term profit pain,
Yeah.
what did management say about the payoff? Why is this the right thing to do now?
They were very clear the economics are compelling based on how the already converted stores are doing.
The double-digit growth ones.
Right. They see a 2 to 3 year payback period on that P&L investment per store.
2 to 3 years, that's pretty quick.
Yeah. So they stated pretty emphatically, this makes the rebanner program the single best use of their capital right now, offers good returns relatively quickly.
And this brings us right back to that strong balance sheet we mentioned earlier. That $93 million cash, zero debt, that has to be absolutely crucial for funding this without, stressing the company out financially.
Totally crucial. That financial strength is the engine making this acceleration possible. It lets them self-fund all this, the CAPEX, the P&L hit, when maybe competitors with more debt couldn't even consider such a pivot, especially now.
Right.
And it also supports that deliberate inventory strategy we talked about.
Let's circle back to the inventory for a sec. Did they say where they were putting that extra investment? Any specific shoe categories?
They did highlight performance running brands. That was a key area of investment within that higher inventory level.
Yeah.
And apparently those are doing really well, especially at Shoe Station. Seeing double-digit sales growth there with average prices over $130 a pair.
Wow, $130 average. That definitely fits the premium banner focus.
Absolutely.
What about across all categories? Athletic, non-athletic, kids? Did Shoe Station consistently beat Shoe Carnival within those buckets too?
Yes, the pattern held pretty much across the board. In women's non-athletic, Shoe Carnival was down, but Shoe Station saw strength in things like dress shoes.
Interesting.
Men's non-athletic, Shoe Station was stronger in casuals. Even in kids, which was particularly soft for the traditional Shoe Carnival stores, maybe due to caution from lower-income families.
Yeah, makes sense.
Shoe Station saw only a low single-digit decline, still outperformed significantly. It suggests the whole Shoe Station model is just more resilient right now.
Okay, so the strategy is clear. Full speed ahead on Shoe Station. Driven by the results, enabled by the cash, even with the near-term profit dip. When do they actually expect this big shift to start lifting the total company numbers back into growth?
They give a specific time frame for that. They expect the growing scale of Shoe Station to finally outweigh the softness in the legacy banner and drive overall growth again starting in the third quarter fiscal 2026.
Q3 2026. Okay, so about a year and a half out based on their current plan?
Yeah.
That's a key milestone to watch.
Definitely.
What's the ultimate vision then? Beyond 2027, beyond 80%, could Shoe Station become the whole company eventually?
100%.
Management is definitely thinking about it. They're planning specific tests in major urban markets. Chicago and Houston were named, starting by early 2026.
Urban tests, why?
To see if the Shoe Station format can work effectively with those lower-income, highly diverse urban customers, kind of like the Georgia example, but on a bigger, tougher scale, maybe.
Right.
If those tests work out, they think converting pretty much everything, maybe even 100%, could unlock significant synergies, cost savings, efficiencies across the business by 2027 or later.
And they didn't completely shut the door on acquisitions either, did they? Still part of the long-term plan. Correct. M&A is still on the radar. They're keeping an eye out for opportunities to buy other, market-leading footwear retailers if the price is right. That balance sheet gives them the power to act if something good comes along.
Before we shift gears, what did they say about the bigger picture? The macroeconomy. What's the biggest worry or unknown for them?
Consumer sentiment. That was the biggest near-term question mark, especially heading into back to school.
Yeah, always huge for shoe retailers.
They acknowledged folks are cautious, especially the lower-income customers core to the old Shoe Carnival stores. Tariffs got a mention, kind of fluid, but they haven't seen big price hikes from vendors yet. And again, they pointed to their inventory strategy and lack of wholesale business as helping them navigate that.
Okay, so zooming out, what does all this really mean for you listening, maybe following this company or just the retail space in general?
Well, Shoe Carnival is basically in the middle of this massive, super fast, high conviction pivot. They are actively shifting away from a part of the market facing real headwinds, that value-focused, lower-income shopper served by the traditional stores.
Right.
And doubling down hard on this premium, higher-margin Shoe Station concept that's been working well for years.
They're pretty much cannibalizing their weaker banner to scale up the stronger one fast.
Yeah.
And putting serious money behind it, that $25 million P&L drag, up to $40 million in CAPEX this year.
Because the early results from those conversions, the payback time, it looks compelling to them.
Yeah. And the fact that Shoe Station seems to be working not just in wealthy areas, but in rural spots, and even showing promise in that lower income Georgia market, that suggests this concept might actually have broader national appeal than maybe even they first thought.
Could fill a real competitive white space they think exists.
And that financial strength, the cash, no debt, it's just absolutely critical here, isn't it? It's what lets them make these huge bets when other retailers might be forced to just, tread water or cut back.
Absolutely. It's a key differentiator. And that guidance reaffirmation, even with the profit hit from investments and the soft sales, that's a strong signal of management's confidence, right or wrong.
They're pointing to Q3 2026 for that return to overall comp growth, betting big on the Shoe Station scale-up delivering by then.
So key things to watch. Definitely keep an eye on Shoe Station's performance as it expands. How do those urban tests in Chicago and Houston go by early 2026? Can they actually hit this super aggressive conversion schedule?
Yeah, 75 stores this year is a lot of work.
And of course, the big unknown, consumer spending, especially for back to school this year.
Okay, buckle up then. Time for our segment where we toss around some outrageous but plausible ideas based only on what we heard in the earnings call. Let me stress, this is absolutely not financial advice.
Do your own research. Seriously, this is just us thinking aloud, connecting dots from the call narrative itself.
Okay. Idea number 1. We heard management talk a lot about Shoe Station working across different markets, right? Suburbs, rural, even that lower income spot. And how that contrasts with the struggles of the traditional Shoe Carnival banner aimed at lower income folks.
Yeah, the white space idea for Shoe Station versus the crowded value segment was a big theme.
So if Shoe Carnival sees challenges with that lower income customer and thinks Shoe Station is in a better, less crowded space, what if you considered this? A short position. Not on Shoe Carnival, but on a basket of their public competitors who are primarily focused on that traditional value-oriented family footwear customer.
Interesting. The company Shoe Carnival is kind of pivoting away from competing as directly with.
Exactly. The idea, the thesis, is that the macro headwinds hitting that lower income consumer, the ones Shoe Carnival is feeling, might hit those solely focused competitors even harder, especially if they don't have a high-performing premium growth engine like Shoe Station to offset some of the pain.
It's a bet that the segment Shoe Carnival is de-emphasizing will face disproportionate pressure.
Okay, I see the logic, based purely on their narrative.
All right, idea number 2. The call really hammered home the accelerated Shoe Station timeline, right? Over 51% of the fleet by July 26 for back to school, over 80% by March 27.
Yeah, and they explicitly tied that to expecting total company comp growth to resume in Q3 26 and potential big synergies by 27 if the urban tests work.
So this is clearly presented as a transformation story with specific dates for when things are supposed to get better, when the investment should start paying off.
Okay.
So instead of buying the stock now and maybe just waiting through this period of heavy investment and soft sales they've flagged, what about structuring a long play using long-dated call options?
Options. Targeting expirations way out, like late 2026 or into 2027. Exactly. The strategy would be to try and capture the potential upside if they hit their targets that return to comp growth. The profit improvement as Shoe Station scales, maybe those synergies, while limiting your upfront capital compared to owning the stock through the investment phase.
So it's basically a leveraged bet that management executes this whole accelerated plan successfully on the timeline they laid out on the call.
Precisely. Again, not advice, just an idea directly spun out of their own projected timeline and inflection points.
Got it.
Okay, so to wrap up this deep dive on Shoe Carnival's Q1 call, the main takeaway seems pretty clear. Yes, they're navigating a tough retail patch. Yes, they're making investments that are hitting profits right now. But the big story is this aggressive, high-stakes, super-fast pivot to the Shoe Station banner.
Yeah, the early results they shared, especially Shoe Station working in diverse markets, seems to be fueling their confidence. But, let's be real. Challenges definitely remain. The consumer is shaky, especially for their traditional stores. And pulling off this massive fleet transformation in just over 2 years, that involves significant execution risk. No guarantees.
Absolutely. And remember, everything we talked about today comes straight from the company's earnings call. It's for your information only. We're not endorsing their views, just reporting what they said.
And one more time for the people in the back, those trade ideas. Just ideas, based purely on the call narrative, not recommendations. Please, do your own homework.
Okay, here's a final thought to leave you with, something to mull over. If Shoe Station really does succeed broadly in these diverse markets, maybe even in the upcoming urban tests, does this accelerated transformation fundamentally shake up the competitive landscape for everyone in footwear?
Could it force both the traditional value players and the existing premium players to adjust their strategies to compete against this sort of rapidly scaling hybrid model?
Something to think about. We'd love to hear your thoughts.